Did you know that when you buy a home, thousands of your dollars vanish into an escrow account, often without you fully understanding why? For many, this isn't just a minor detail. It's a significant chunk of change that banks hold on to, sometimes totaling several $1,000s up front. This isn't just about your down payment or closing costs. This is about an extra layer of money held aside, specifically for things like property taxes and homeowners insurance. Most people just shrug and pay it, but failing to grasp how escrow truly works can lead to unexpected shortages, payment hikes, or even missed opportunities to reclaim your funds. We're going to demystify this entire process, showing you exactly where that money goes and how to prevent costly surprises down the line. So what exactly is escrow? At its core, an escrow account is a special holding account managed by a neutral third party, often your mortgage lender or a dedicated escrow company. Think of it as a temporary safe deposit box for money and documents, ensuring all parties in a transaction uphold their end of the bargain. In real estate, there are two main types. One during the closing process, holding funds until the sale is complete, and the other, an ongoing account managed by your lender to pay your property taxes and homeowners insurance. This second type is what we're focusing on today, and it's where most homeowners lose track of their money and face the biggest headaches. But why is it even necessary for your lender to hold these funds? For many homeowners, an escrow account isn't optional. It's a mandatory condition of their mortgage. Lenders require escrow to protect their investment. Imagine you stop paying your property taxes. Eventually, the local government could place a lien on your home or even foreclose to collect those taxes. If your home goes into foreclosure for unpaid taxes, the lender could lose their collateral. Similarly, if your home burns down and you don't have insurance, the lender loses their investment. By collecting a portion of your property taxes and insurance premiums with each monthly mortgage payment, the lender ensures these critical bills are paid on time. This minimizes their risk, but it also creates a significant financial obligation for you, and sometimes a large upfront payment. But how much are we really talking about? Let's put some real numbers to this. When you close on a home, your escrow account needs an initial deposit, often called an escrow impound, or prepaid items. This isn't just a few $100s. For a typical home in a U.S. suburb, say valued at $400,000, with annual property taxes of $6,000 and homeowners insurance of $1,800, your lender might require you to prepay several months' worth of these expenses. If they ask for 3 months of taxes and 3 months of insurance, that's $1,500 for taxes, $6,000/12 by 3, plus $450 for insurance, $1,800/12 by 3. That's $1,950 just for the initial escrow setup, in addition to your closing costs and down payment. And that's conservative. Some lenders require even more, easily pushing this into the thousands. This initial payment is crucial to understand, as it directly impacts how much cash you need at closing. After the initial setup, escrow seamlessly integrates into your monthly mortgage payment. Instead of making separate payments for your principal, interest, property taxes, and homeowners insurance, your lender bundles them all into one convenient sum. So, if your principal and interest payment is $1,800, your monthly property tax contribution is $500, $6,000/12, and your insurance is $150, $1,812. Your total monthly payment would be $2,450. The lender collects that full amount, then holds the $500 for taxes and $150 for insurance in your escrow account. When your tax bill or insurance premium comes due, usually once or twice a year, the lender pays it directly from your escrow account. It sounds simple, but this convenience can mask a common and costly problem: the escrow shortage. Here's where many homeowners run into trouble: the dreaded escrow shortage. Imagine your property taxes unexpectedly jump by 10% in 1 year, or your homeowner's insurance premium increases due to rising rates or claims in your area. Your lender calculated your monthly escrow contribution based on previous year's figures. If those costs go up, your escrow account won't have enough money to cover the full bill when it's due. The lender will pay the bill, but then they'll send you a letter demanding you make up the difference, sometimes thousands of dollars, either as a lump sum or by significantly increasing your monthly escrow payment for the next year. This is a common shocker for homeowners who aren't tracking their tax and insurance statements, but it's entirely avoidable if you know what to look for. Here's a common myth we need to debunk. Many people believe their escrow account earns interest, or that the bank somehow profits from holding their money. For the vast majority of homeowners in the U.S., this is simply not true. While some states do mandate interest on escrow accounts, it's typically a very low rate, like 0.1% or 0.25%, and many states don't require it at all. So, your lender isn't putting your escrow funds into a high-yield savings account and pocketing the difference. They're primarily holding it to mitigate their risk. This means that money is essentially sitting dormant, not growing for you. Understanding this truth can help you make smarter decisions, especially if you have the option to waive escrow. Is it possible to avoid escrow altogether? Sometimes, yes. If you make a substantial down payment, typically 20% or more, and have excellent credit, some lenders will allow you to waive the escrow requirement. This means you'd be responsible for paying your property taxes and homeowners insurance directly when they come due. The benefit? You maintain control of your money, potentially earning interest in a high-yield savings account until those bills are due, and you avoid the risk of escrow shortages. The downside? It requires discipline. You must budget and save for those large, infrequent payments yourself. Miss a property tax payment, and you could face severe penalties or even a tax lien, which is a major risk. So, it's a trade-off that requires careful consideration. Every year, your mortgage lender will conduct an escrow analysis. This is where they review your past year's property tax and insurance payments, estimate the upcoming year's costs, and compare it to the funds you've contributed. This analysis is crucial. If your account has a surplus, meaning you've paid too much, they'll send you a check for the excess. If there's a shortage, they'll notify you and give you options to cover it, usually by increasing your monthly payment. This annual statement is your opportunity to catch errors, understand changes in your taxes or insurance, and ensure your account is balanced. But what if you disagree with their findings or suspect an error? What if your annual escrow analysis seems off, or you believe your property tax or insurance figures are incorrect? Don't just accept it. This is your money. First, compare the lender's figures to your actual tax bills and insurance premium statements. Did they use the correct amounts? If you find a discrepancy, gather your documents and contact your lender's escrow department immediately. Be prepared to provide proof, like copies of your tax assessments or insurance declarations. They are legally required to investigate and correct errors. Failing to do so could mean you're overpaying for months or even years. This proactive approach can save you hundreds, if not thousands, of dollars over the life of your loan. But there's an even bigger mistake some people make that costs them dearly. One of the biggest mistakes homeowners make with escrow is ignoring their property tax and insurance statements, assuming the lender has it all covered. Here's what happens if you do. Imagine your property value is reassessed, leading to a significant jump in taxes. Your city sends you a new tax bill, but you toss it, thinking your lender will handle it. While your lender will eventually pay the bill, they'll likely do so from an already underfunded escrow account. When the annual escrow analysis comes, you'll be hit with a massive shortage, possibly thousands of dollars, that you'll have to pay back. By staying informed and reviewing these statements yourself, you can anticipate changes and proactively adjust your escrow contributions or even dispute incorrect assessments, saving yourself from a huge financial headache down the road. So, what concrete steps can you take to manage your escrow effectively? First, keep copies of all your property tax bills and homeowners insurance declarations. Second, when you receive your annual escrow analysis from your lender, compare it meticulously to those documents. Third, if you have the option and the financial discipline, seriously consider waiving escrow after you've built up 20% equity. This gives you full control. Fourth, if you receive a notice about rising property taxes or insurance premiums, proactively contact your lender to discuss adjusting your monthly escrow contribution, rather than waiting for a shortage. These simple habits can save you a lot of money and stress, ensuring that your homeownership journey remains smooth and predictable. But what about when you sell your home? What happens to that money? Understanding escrow is about more than just a payment. It's about protecting your biggest investment and avoiding costly surprises. The key takeaway is to never just set it and forget it. Be proactive, review your statements, and stay informed. If you're now wondering what happens to your escrow funds when you sell your home, or how to get that surplus back quickly, watch our video on getting your money back. Escrow refunds explained. Next, don't forget to subscribe for more straightforward explanations of complex real estate topics.